Paul Tudor Jones was born in Memphis, Tennessee in 1954 into a world that prized manners, hierarchy, and competitive excellence. He did not emerge from obscurity so much as from preparation. His father was a lawyer. His upbringing was orderly, disciplined, Southern. Yet Jones was never designed to sit quietly inside institutions. He absorbed structure only to learn how to bend it. He attended the University of Virginia, where he boxed as a heavyweight. This detail matters. Boxing teaches you that pain is information, not injustice. It teaches you distance, timing, and respect for risk. Jones carried this sensibility into markets. He did not fantasize about invincibility. He trained for survival. After college, he entered Wall Street in the 1970s, a period of inflation, volatility, and ideological confusion. The old certainties were breaking down. Fixed rules were dying. This was fertile ground for a mind that distrusted dogma. Jones learned commodities trading under Eli Tullis, where he discovered that markets move not because they are rational, but because humans are emotional under pressure. In 1980, he founded Tudor Investment Corporation. He was young, ambitious, and aggressive, but not reckless. From the beginning, his edge was not prediction, but risk control. He understood something that most traders learn too late. You do not need to be right often. You need to be wrong small. His defining moment came in 1987. In the months leading up to the stock market crash known as Black Monday, Jones became increasingly bearish. He studied historical analogues, particularly the 1929 crash. He noticed similarities in credit expansion, speculative excess, and investor psychology. He did not declare certainty. He prepared for asymmetry. When the crash came, Jones was positioned to profit massively. His fund reportedly returned over 100% that year. Overnight, he became a legend. Yet he resisted the temptation to mythologize himself. He did not claim genius. He emphasized discipline. Jones's philosophy begins with one brutal axiom. Capital preservation is the first rule of trading. Everything else is secondary. You cannot compound if you are destroyed. Ego is the enemy. Hope is poison. The market does not reward courage. It rewards accuracy and humility. He is famously intolerant of large losses. Jones has said that the most important rule is to cut losses quickly, not after they become unbearable, not after your thesis is invalidated intellectually, immediately. The moment the market tells you that you are wrong, you obey. You do not argue with price. He believes that markets are probabilistic, not deterministic. No trade is sacred. No idea deserves loyalty. You are not married to your positions. You rent them, and when the rent rises, you leave. Jones distrusts forecasts. He does not believe in knowing where the market will be next year. He believes in reacting correctly to what is happening now. The present contains more information than any narrative about the future. Traders who obsess over prediction tend to ignore risk. Traders who obsess over risk tend to survive. Another cornerstone of his thinking is emotional self-regulation. Jones is acutely aware that trading is a psychological game played with real money. Fear and greed are not abstract concepts, they are physiological states. The trader who cannot manage himself cannot manage a portfolio. He advises reducing position size when emotionally compromised. If you are angry, euphoric, or desperate, you trade smaller or not at all. The goal is longevity, not heroics. Consistency beats brilliance. Jones is also known for his macro perspective. He studies monetary policy, interest rates, currencies, and political incentives. He understands that markets are downstream from power. Central banks, governments, and institutions shape the terrain. You may not like this reality, but you must price it in. At the same time, he warns against overconfidence in macro narratives. Big themes can blind you to timing. Being early is indistinguishable from being wrong. The market can remain irrational longer than you can remain solvent. Therefore, he waits for confirmation. Price action matters more than opinion. One of his more subtle insights is that volatility itself is tradable information. Calm markets breed complacency. Complacency breeds leverage. Leverage breeds fragility. When volatility is low, risk is often high, even if it feels safe. Jones watches volatility not as noise, but as a warning system. He also emphasizes adaptability. What worked in one decade may fail in the next. Strategies decay, edges erode. The trader who survives is the one who evolves. Jones has reinvented his approach multiple times, incorporating new data, new instruments, and new constraints. He treats trading as a living craft, not a static system. Despite his fearsome reputation, Jones is not nihilistic. He is deeply philanthropic, particularly focused on education and poverty alleviation. This, too, is instructive. He does not see wealth as a substitute for meaning. He sees it as a tool. In later years, Jones has spoken more openly about the dangers of inequality, debt, and monetary excess. He remains wary of bubbles, especially those fueled by easy money and moral hazard. His skepticism has not softened with age, it has sharpened. If his advice were reduced to its essence, it would sound like this: respect risk above all else. Trade what you see, not what you believe. Cut losses without hesitation. Never confuse confidence with certainty. And remember that survival is the ultimate victory. Paul Tudor Jones is not a prophet. He is a professional survivor. He does not promise riches. He promises something rarer: the discipline to stay in the game long enough for probability to work in your favor. Paul Tudor Jones never mistook intensity for edge. Many traders confuse aggression with skill. Jones learned early that aggression without structure is just noise. What distinguished him was restraint, an almost monastic refusal to let impulse masquerade as insight. He understood that the market punishes emotional urgency more reliably than ignorance. As his career progressed, Jones refined his operating principles into something closer to a code. One principle dominated all others: defense precedes offense. He structured portfolios so that no single idea could threaten survival. Diversification was not cosmetic, it was functional. Correlations mattered, liquidity mattered, exit mattered more than entry. He often spoke about the danger of getting too big. Size changes behavior. When positions grow large, flexibility shrinks. Traders begin to justify instead of adjust. Jones viewed this as a silent killer. He deliberately constrained exposure, preferring to leave money on the table rather than risk paralysis. Missing upside was tolerable. Losing maneuverability was not. Jones was also deeply aware of feedback loops. Markets are reflexive systems. Price changes behavior. Behavior changes price. This insight shaped his caution around crowded trades. When too many participants share the same narrative, the risk is no longer in being wrong, it is in being late. Jones learned to sense when consensus itself had become fragile. His study of history was not nostalgic, it was tactical. He did not search for perfect analogues, but for recurring human behaviors under stress. Manias, panics, denial, and capitulation repeat because human biology does. Tools change, incentives remain. This is why he paid attention to long-term debt cycles, currency regimes, and political pressure on monetary authorities. Jones held a sober view of central banks. He recognized their power, but he never trusted their permanence. Policies designed to stabilize often create second-order instability. Artificial suppression of volatility, in his view, does not eliminate risk, it stores it. When release comes, it is violent. This awareness made him skeptical of smooth narratives and linear projections. He also rejected the idea that intelligence alone confers advantage. Many brilliant minds fail in markets because they cannot accept uncertainty. Jones accepted uncertainty as the base condition. His confidence came not from knowing outcomes, but from knowing his responses. He did not need to predict the future, he needed to remain solvent across many futures. One of his less discussed strengths was preparation. Jones was obsessive about pre-mortems. Before entering positions, he imagined failure scenarios. What if liquidity vanished? What if correlations converged? What if the policy backdrop flipped overnight? By rehearsing loss in advance, he reduced panic in real time. The surprise was not the loss, it was the magnitude, and that was controlled. He discouraged overtrading. Activity feels productive, but it often dilutes edge. Jones preferred to wait, sometimes for long periods, until the risk-reward asymmetry was clear. When conditions aligned, he acted decisively. Patience was not passivity, it was capital discipline. Jones also believed deeply in self-knowledge. He tracked his own psychological patterns with the same rigor he tracked markets. He knew when he was vulnerable to overconfidence and when fear distorted perception. This introspection was not therapeutic, it was strategic. The trader is part of the system. Ignoring that variable is malpractice. As technology advanced, Jones adapted without surrendering principles. Algorithms, faster data, and increased leverage changed execution but not reality. Markets still punished excess, hubris, and rigidity. He integrated quantitative tools while maintaining discretionary judgment. Numbers informed him. They did not replace him. Importantly, Jones never framed success as permanent. He expected drawdowns. He expected regime shifts. He expected periods where nothing worked. This expectation inoculated him against despair. When losses came, they were signals, not verdicts. He reduced exposure, reassessed, and waited. Many careers ended where he merely paused. In public appearances, Jones often warned young traders about glamour. Trading is not a lifestyle, it is a discipline. It requires boredom tolerance, emotional regulation, and relentless honesty. The market does not care about your story, your needs, or your brilliance. It responds only to pressure and flow. He emphasized that luck plays a role, but only once. Sustained success is not luck repeated, it is process validated. Survivors design systems that benefit from randomness rather than deny it. Jones built such systems by accepting that variance is unavoidable and managing it accordingly. His philanthropy, particularly through initiatives addressing education and inequality, reflected a long view. He understood that unstable societies produce unstable markets. Social fragility eventually expresses itself financially. His concern was not moral posturing, it was systemic awareness. As decades passed, Jones became increasingly vocal about excess leverage, debt addiction, and policy distortions. He did not predict collapse dates, he signaled structural tension. His message remained consistent. When incentives are misaligned, outcomes degrade. The longer distortions persist, the more violent the correction. Jones's legacy is not a single trade or year, but a mindset. He demonstrated that dominance in markets does not require bravado. It requires humility paired with precision. It requires the courage to exit early, the discipline to wait, and the self-command to remain intact when others unravel. In distilled form, his worldview is unsentimental. Markets are not fair. They are not educative. They are not moral. They are mechanisms for transferring capital from the undisciplined to the disciplined. The trader's task is not to be clever, but to be resilient. Paul Tudor Jones endures not because he was always right, but because he structured his life and his trading so that being wrong never ended him. In a domain that destroys certainty, that is mastery. Paul Tudor Jones's final and perhaps most enduring insight is this: markets are not puzzles to be solved, but environments to be survived. This distinction separates amateurs from professionals. The amateur believes there is a hidden answer, a master key, a formula that will make uncertainty submit. Jones knows better. He treats uncertainty as permanent and designs his life around that permanence. He understands that convexity is destiny. When systems are stretched, financially, politically, socially, small errors propagate into large consequences. Jones watches for these moments not with excitement, but with sobriety. Convexity rewards preparation and punishes complacency. He positions so that surprise works for him, not against him. He is deeply attuned to second-order effects. Policies are never isolated. Interventions ripple. When rates are cut, behavior changes. When volatility is suppressed, leverage grows. When leverage grows, fragility accumulates. Jones is less interested in what an action is meant to do than in what it incentivizes people to do next. Incentives, not intentions, move markets. Another of his insights lies in his rejection of linear thinking. Most forecasts assume smooth progression. Jones assumes discontinuity. Regime shifts do not announce themselves politely. They erupt. His respect for discontinuity is why he maintains flexibility even during long periods of calm. Calm is not safety, it is often prelude. Jones also understands the psychology of scarcity and abundance. When capital is scarce, discipline is natural. When capital is abundant, discipline must be enforced artificially. Easy money dulls risk perception. Jones resists this dulling. He behaves conservatively when others relax, and aggressively only when fear has already done the pruning. He has spoken about the danger of narrative addiction. Humans crave stories. Stories reduce anxiety. Markets exploit this craving. The more coherent a narrative becomes, the more dangerous it often is. Jones uses narratives only as context, never as justification. Price must agree. If it does not, the story is discarded. He is also clear-eyed about status risk. Public success creates pressure to maintain an image. This pressure corrupts decision-making. Jones avoids this trap by prioritizing private correctness over public admiration. He does not need to be seen as right. He needs to remain solvent. This choice grants freedom. Jones's approach to drawdowns late in a career is especially instructive. Many seasoned professionals become brittle, defending legacy rather than adapting. Jones does the opposite. He reduces size, revisits assumptions, and accepts that the world may no longer reward what once worked. Pride is not allowed to calcify process. He also understands the role of boredom. Boredom is not an enemy. It is a filter. Those who cannot tolerate boredom overtrade. Jones welcomes boredom as proof that he is not forcing opportunity. He waits until opportunity forces him. One of his quieter insights is about attention as capital. Attention is finite. Where you direct it shapes outcomes. Jones protects his attention fiercely. He avoids noise, outrage, and performative debate. His informational diet is lean. This leanness preserves clarity. He has also emphasized clean exits over perfect entries. Many traders obsess over getting in at the exact right moment. Jones cares more about getting out intact. A mediocre entry with a clean exit beats a brilliant entry with a frozen exit. Liquidity, again, is king. Jones's understanding of risk layering is sophisticated. Risks compound. Market risk interacts with liquidity risk, which interacts with behavioral risk. He avoids stacking fragile risks atop one another. When one risk rises, he reduces others. This orchestration is subtle and rare. He also appreciates the asymmetry of recovery. Losses require larger gains to repair. A 50% loss requires a 100% gain to break even. This arithmetic governs his caution. Avoiding large losses is not conservative. It is mathematically aggressive. Another insight is his refusal to outsource responsibility. No model, no committee, no authority absorbs blame. Jones owns outcomes fully. This ownership sharpens judgment. When excuses are unavailable, discipline improves. He understands that markets punish certainty more than ignorance. Ignorance can be corrected. Certainty resists correction. Jones cultivates a mindset that is confident yet provisional. He holds views lightly and abandons them quickly when contradicted. Jones's later reflections increasingly emphasize systemic fragility beyond markets. Political polarization, debt overhangs, demographic stress all feed back into financial systems. He does not moralize these trends. He prices them. His realism is unemotional and therefore actionable. At the end of all this analysis, his philosophy condenses into a few principles that repeat across decades. Survive first. Cut losses without debate. Size position so your nervous system remains functional. Respect price above opinion. Prepare for discontinuity. Adapt relentlessly. There is no romance here. No cinematic triumph. Just professional endurance. Paul Tudor Jones's legacy is not that he predicted crashes or timed markets perfectly. It is that he designed a life and a system that could withstand being wrong repeatedly without breaking. In a domain where most are eventually erased, that is a rare form of excellence. If you have found value in this distilled wisdom, if you respect survival over spectacle, like and subscribe for more financial wisdom from history's greatest traders and investors, distilled. Because in markets, as in life, the quiet lessons are the ones that keep you standing when the noise collapses.